We touched on a lot of things there, and I think there's a couple of really good foundational principles that you talk about. And for anybody listening, when we have the show notes here, we'll give away copies of the book and everything. Infinity book is absolutely amazing. Base it off of a wheel strategy. So talk a little bit first about what the wheel strategy is and how the average person can use it. And then I'd like to ask you some follow-up questions on each piece of the wheel a little bit, and then kind of give you some time to talk about whatever it is you're excited about today.
Yeah, perfect. The wheel strategy is Eric Dodd's. He does a great job of teaching this. And what you're doing is these things called options. And some people are used to options. They think about like option to buy a house or something like, hey, I have a house. It's 200,000, but I want to be able to buy it from you for 200,000, but I want to lock it down for 6 months. I want the option to buy your house at 200 grand for the next 6 months. And they might sell you that for, let's just say they all right, $5,000 and you can buy it. No matter what the house does, if it goes up in value, you can still buy it for 200,000. And so it's just locking in a price. So a lot of people are used to that. You can do that in the stocks, and you can buy or sell. You could be on either side of it. I believe that you sell options. I believe that it's really tough to make money buying options. And there's folks out there that teach this stuff. I'm just saying from my client standpoint, the people that make the money consistently are the sellers. And yeah, sometimes they buy them back. I get it that there's some advanced strategies, but just 10,000 foot view, you're making your money selling the right for someone to buy whatever it is you bought on it. Now, there's this thing called a put where you can basically sell the right to somebody to make you buy something at a price. So think of it like this. You say to that same homeowner, that's a $200,000 house, you want me to buy that at 200,000 for the next 6 months? If you give me 5,000 bucks, you can make me buy that house at 200,000, even if it's worth less, right? And you're looking at it going, but I would buy the house at 200,000. It's a great deal. Good. Sell that put. Sell them the option to make you buy it at the price that you want to buy it at anyway. You can do that in the stock market. So the wheel strategy is nothing more than marrying those two together. When you enter a position, we do something called a cash secured put. You sell somebody the right to make you buy the company at a price that you buy it at anyway. And what oftentimes happens if that company continues to stay where it is or go up, you never get called out. You just get free cash. And then sometimes they say, no, I want you to buy it at that price. Maybe it dips down a little bit. And you're like, okay, I get to keep the money that they gave me. Plus I would have bought it anyway. And then you start selling calls. You sell the option for someone to buy it at a price greater than what you paid for it. And, that is just a fancy way of creating multiple streams of income off of one security. Eric is awesome at this. And we have a ton of folks that are in our Infinity investing that do very well doing this. Like they're making 1-2% a month just doing that. And, people might say, well, but, Bitcoin's greater. I'm not saying don't do Bitcoin, but Bitcoin's not money in the bank that you can live off of. I like the income that's being produced. Bitcoin to me I use buckets. So I have 4 buckets. There's the 10% bucket, which is cash or cash equivalents. That's where I'd put gold and Bitcoin. Those are hedging. There's income producing stocks that I would put in 30% bucket, 30% bucket in real estate or real estate equivalents like a REIT. And then 30% in managed money. And when I say managed money, you could actually have somebody managing it for you. But if you're just getting started, maybe it's ETFs, maybe it's a syndication. If you're an accredited investor, it's something where somebody else is making the decision. Because what ends up happening is if one of them, like if we have crashes, it's rare that you see all three go get trounced. Usually you're going to be pretty successful when you spread out that risk. It's kind of like, I heard this quote once is, money is like manure. If you leave it in a pile, it stinks. But if you spread it out, things grow. And so we're spreading it out among some various buckets. And then you can do different strategies inside those buckets. But this is to, because there's folks out there, I have them on both sides that only do securities, only do real estate, only do Bitcoin, or only, hey, I just have a financial advisor and I hand it to them. You really should be looking at spreading and looking at those buckets to make sure that you're not overweight in one particular area. These are pretty easy percentages to kind of follow. It's 30, 30, 30, 10 for anybody who's trying to track it. It's 30% in income producing stocks. I tend to like dividend kings and dividend aristocrats, companies that have been increasing their dividends for at least 25 years. Dividend kings, or they've been increasing their dividend for at least 50 years. I gravitate towards safety. I like those. And then you do the wheel strategy with those. You have a great deal of success. And there's some institutions, by the way, that do some of these. My favorite is there's an ETF called Devo. That's Kevin Simpson and his group that manage that. And they do very well creating call income, dividend income, and they still have growth. I think they're 12%, 13% a year, something like that since their inception. Great little ETF in that bucket. The other bucket is real estate, which you could be buying your own real estate. These people that, if you like single family residences, I do. I got a ton of that stuff. I have apartment buildings. I have duplexes, 8-plexes, 16-plexes, 12-plex, whatever. Mobile home parks. Yeah, I got some of those. Commercial buildings. Yeah. I like dibbling and dabbling in real estate. That's where you can do that. But if that's not for you, if you're like, oh man, the last thing I want to do is be a landlord. Okay, then buy a REIT. Federal Realty Trust has been increasing its dividend or its payout every year for over 50 years. There's a bunch out there. There's PS, there's public storage, there's all sorts of different ones. And then you have your managed money, which I always say you just want to have somebody else that you might be looking at. So you could be mirroring their portfolio. You could use financial planners. I have multiple that I use. I like to see what they're doing because I like it's brain food to me. It's like, okay, what do you recommend that we do? What do you I have 3. So I'm always asking them, what do you guys recommend? The Fed just lowered interest rates. What do you recommend? I'm just looking for different ideas and consistency. And that's all you're doing. So you're saying, hey, it's not just me making the decision. I'm really looking at somebody else. And that's usually where your syndications live too. And syndications can be great. They could also be a complete loss. There's no guarantee in any of those things. So you just want to make sure that you're divvying these things up. So if something bad happens, you don't have to make lifestyle changes or big changes. And if somebody's wondering, where would you start? I would start in that. The first bucket is income producing stocks because they're very liquid. I can get to them quick. That's me. I'm just always going to say that you don't want to be in a situation where the first thing you buy is a single family house. It was with your last dollar and then you got to replace the roof. You're going to be pretty pissed off. So you want to make sure that you're doing things. And hey, if I have a life change or I need some cash, I need to know that I can get to it easy. And it's, if you're buying your whole investments are all in real estate, that can be a slow return of that money, right? You have to sell it. You remember 2007, 2008, everybody ran for the exit at the same time. And the people that were forced to sell didn't do too well. People that didn't have to sell were fine, recovered, fairly quickly. But still, if you were in a situation where you had an adjustable rate mortgage and you had to refi and you couldn't refi and then you had to sell or whatever, you're upside down, that was a painful experience. So you don't want to be in that. So I always say start with the liquid, then move to real estate, then move to kind of more managed, do more your syndications or do your managed money.